Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB. I'm Andrew Gagan. Thanks for joining us as we wrap up the day and the week here at AusBiz. And it's been a positive session. A bit of a turnaround, obviously, given what we saw yesterday with the worst day in more than 2 months. We've almost regained those losses. So there's a look at the CBO 200 index, up 1.3%. Similar moves there we've seen on the S&P ASX 200. Just getting that up on my screen, it is up 1 1/3% at this point. So that's after that news out of the Middle East with the US and Iran reaching a tentative deal to extend their ceasefire by 60 days. And that allows room for them to negotiate, particularly in terms of Iran's uranium stockpile, but more crucially, reopening the Strait of Hormuz. So the S&P ASX 200 crossing back above its 50-day moving average, and over the past 5 days, in fact, it's gained around 0.6%. But for the year to date, unchanged. No progress whatsoever, as the case may be. All right, let's get across the themes of the day then. And there's a rebound in stocks there, almost regaining what we lost yesterday. Straight fate. Well, what is to become of the Strait of Hormuz? Still a lot of unknowns there. I mean, clearly the aim most immediately is to reopen the traffic there, but who controls that? And Wall Street records, well, they continue to tumble on Wall Street. Seems to be the norm day by day. In fact, the 3 major indices there overnight, the S&P 500, the NASDAQ, and the Dow. Once again, more records, very much driven by that ongoing AI trade. Let's get to sectors of the day, those that have moved today in response, particularly to that news out of the Middle East. And the gold miners back in play. They were the worst affected yesterday. So everything that was down yesterday is up and vice versa. Northern Star leading the gains there, Evolution, Newmont, Ramelius, Genesis. Elsewhere in the energy space, well, that goes to what I was just saying there, the energy trade unwinding, led by Santos and Woodside. Karoon coming off the worst there. And tech, broadly higher. WiseTech is negative, but Tech One and NextDC, pick of the bunch there, up around 2.5% or so. Getting across the stories today, Judo Capital, that's up on a $537 million capital relief deal, and Citi also maintaining a buy rating on the stock. IAG, the insurer, resolving a federal court proceedings brought by Greensill Bank and its insolvency administrator over disputed trade insurance policies. Elsight hitting a record on a $2 million purchase order. Webjet's chief executive, Katrina Barry, will leave the online travel company on Sunday. And Bubs Australia expecting FY26 revenue of between $105 and $115 million as expansion in the US helped offset supply chain disruptions and regulatory headwinds for the company. Well, this is that time of the week, and the doctor is in the house. Let's welcome Shane Oliver from AMP. Shane, welcome back to you. Great to have you on the show again as we wrap up the week. Can we start with your observations about what we are seeing on the share market at the moment? Because as I mentioned there, record after record on Wall Street, and the Australian market, goodness, what a laggard it has been. It seems to be much more sensitive to that news flow out of the Middle East.
It certainly is. It's almost as if the US share market has largely moved on, and it's seen huge gains over the last 40 trading days, I think it is. Obviously gone to record highs. Europe is close to record highs. Japan is clearly at record highs. But as you can see from that chart there, we're lagging. Now, even with today's rebound of around 1.3% or something, that green line just takes us back to the previous little high. So we're way below the highs from earlier this year. In fact, we're not that far away from the lows in March in the great scheme of things, whereas other markets are well ahead. I think there's a whole bunch of factors explaining it. We've seen 3 rate hikes in Australia. Other countries have seen none, although they've been talking about hikes, but they're not there yet. Then we've seen better profit numbers coming out of the US, whereas in Australia, if anything, lately we've seen some profit downgrades, profit warnings, and so on. So that's acted as a drag. I think in Australia, there's a lot more scepticism about the Strait of Hormuz. As you say, a lot more sensitivity around whether it will be opened or closed or not. And maybe that reflects the concern that we're a net oil importer. We're a net energy exporter, but we're an oil importer. And I think that leads to greater sensitivity on the part of local investors. And then finally, the tax changes are probably weighing to some degree on investor sentiment. Hard to work out how much. It's not quite the same as the property market, but that's probably another factor in there. So all of those things are leading to this lagging situation. Whereas if you go back before the war, we were actually doing pretty well. There was a rotation away from US tech, and Australia was seen as a beneficiary of that, whereas this has all been messed up, if you like, by the war.
Do you think then possibly, if we do have confirmation out of the Middle East and the Strait is reopened, oil prices come off further, that potentially the Australian market could bounce back very strongly?
It certainly could. I think there is an argument for that. I mean, it's complicated a little bit because the US tech story seems to be stronger than ever. I know there was fears about it at the start of the year, so that's still propelling the US share market. But I think, yeah, if there was confirmation that the Strait of Hormuz is actually opening, and ships are starting to flow through towards normalcy, which is a long way from where we are today, then I think, yeah, we would see a decent bounce in our market. Would we necessarily outperform global markets? You know, that's a bit more uncertain, but I think we would see a good rebound.
So, yeah, Australia proving to be a bit of an outlier as far as the share market is concerned. Also in terms of monetary policy too, of course, Shane, and that is because inflation is running hot here. You could argue it was before the war began. Now, of course, we had that latest read on inflation this week. What did you make of it?
Look, I think it was mixed. The headline number was less than expected at 4.2%, down from 4.6%. Fuel and free public transport in some states were factors in that. But the problem is that the trim mean, the underlying measure of inflation, edged up slightly higher, as you can see in that chart. So we're talking about the monthly number, the what colour is that? Yellow number, and the goldy line in the chart there. It edged up slightly to 3.4% from 3.3%. And so far it still seems to be tracking in line with the RBA's assessment that for this quarter as a whole, it will be growing around 0.9% or 3.8% for the quarter as a whole. So that's still, I guess, the fly in the ointment of all of this. And if you look at housing, new dwelling costs, they're up, and a range of other goods prices, furnishings, I think we're seeing decent gains as well, clothing in there. So, you know, those concerns about inflation are still there. So I think there is room for the RBA, the Reserve Bank, to hold in June, having hiked 3 times. There are some mixed readings on the economy. The inflation numbers were not bad enough to bring on another hike straight away, but we're still penciling in one more hike probably in August.
And in fact, you're saying further good news there. If you break it down in terms, the breadth of price rises improving slightly.
It has. We were in a situation a while back where we'd gone back to a situation where there were more items in the CPI, this is the red line, above 3% than there were items below 2%. Whereas now we're around about balance. In fact, this is slightly more below 2%, which is good news, and that probably holding out hope that we may have seen the worst of it. But ideally, we want to go back to that situation we saw between about June 2024 and June 2025, where the green line, the number of items below 2% was well above the number of items above 3%. I mean, that's what we want to get back to. And if we can get back to that, then I think it would give the RBA confidence to start cutting. But we're not quite at that point yet. And the RBA would still be worried about second round effects from the oil price shock on inflation. They'd still be worried about obviously what's going on in housing. I know rents didn't increase much, but if you look at asking rents, as with data published by SQM and Cotality, that data's still trending up, suggesting that average rents as measured by the CPI will probably rise. And we're also seeing the risk of much higher wage gains, particularly with the national wage case coming up. So all of those things, I think, keep the Reserve Bank probably a little bit on edge, although there's not enough yet to justify, I think, hiking as soon as 2 weeks' time in June.
And Shane, of course, I mean, you referred to this earlier in terms of the implications from the budget, and they're still being felt some 2.5 weeks past the delivery of what the government has handed down, of course, yet to be legislated. There is talk we're going to get some carve-outs, particularly in terms of capital gains tax. What are your observations with that commentary? And I guess particularly the criticism perhaps that the changes should have been purely targeted at the property sector rather than all assets.
It would have made life a lot easier for the government if they'd done that. On their own analysis, there wasn't a huge gain for the share market as a whole, whether you're using one tax system or the other, over the last 25 years, whereas for the property market, the 50% discount in concert with the negative gearing was having a much bigger impact. So I would have thought, to have a quieter life and to avoid upsetting the apple cart, which is what they've done, it would have made more sense to just contain it to the property market. Of course, you don't know those things. Those things in hindsight. Looks that way now, but maybe before the budget they hadn't thought all that through, and I must admit I hadn't thought through the full extent. But I can understand the concerns that startups, tech companies, some small businesses have, and I also worry about the impact on the share market generally, in that this may mean less capital available for newly listed companies on the share market, because investors will bias a little bit towards getting a higher income and lesser capital growth, because income will be taxed, or capital growth will now be taxed a bit more onerously in a relative sense, and that could result in less risk capital being available on the share market. In other words, the share market ends up being more biased towards relatively safe options, but they don't offer the growth potential. So that could be a bit of a negative for Australia, and it would have been nice to have thought those things through a bit more, to debate it a bit more, but unfortunately that hasn't happened. And with the tax changes about to be legislated, maybe it's not going to be happening. I read the Prime Minister saying something to the effect that we shouldn't expect too many carve-outs, which obviously will be a bit of a concern, I guess, for investors to some degree, and that could certainly be weighing on the share market. I mean, that graph that has been bandied around showing Australia going from the lower end of comparable countries in terms of capital gains tax towards the higher end, that would be having some dampening impact in terms of capital gains tax. So I think that's certainly a concern, and one the government should be considering as ways to minimise the damage that it might do, particularly in relation to companies and particularly and also on the share market.
Well, of course, Shane, the weekend is upon us. What do you reckon? Do you think that the great Australian pastime of attending the Saturday auction is over?
Well, for many it might be. I think a lot of investors will be sort of sitting back and waiting till they can get higher rental yields. I mean, this is the basic problem here, that if you remove those tax concessions, and putting aside the arguments as to whether that's a good thing or a bad thing, investors will now get a lower after-tax rate of return. And to compensate for that, it makes sense for them to demand higher rental yield. In other words, a better situation up front, lower prices and or higher rents. And at the moment, we're probably not there yet. Prices are starting to come down in Sydney and Melbourne. I've seen the totality data up till today. It shows a fall last month of about 0.8% in Sydney and about 0.7% in Melbourne. So, we're looking at another soft month. I think Sydney is down by almost 2%. From its high last year, Melbourne almost 3% from its high last year. So the prices are coming down, but probably not enough yet to give investors confidence. So I think they'll be staying away. And then if you're an owner-occupier, you might use the argument, well, I want to get in. I'm a first-time buyer. I could take advantage of the 5% scheme. But the problem is, if I get in now, prices might still fall a little bit further. So I might as well wait. And so you might have owner-occupiers deciding to wait as well, particularly with interest rates on the way up. So I suspect the auction clearance rates remain a bit soft for a while to come. Lately, they've been pushing down towards 50% thereabouts, and that may be the case for a little while yet, as property prices slow down in the boom time cities, Brisbane, Adelaide and Perth, and go further negative in Sydney and Melbourne.
Well, Shane, I assume you have better things to do on the weekend than attend an auction, so enjoy it. We'll catch you again next week. Thanks for joining us on AMP.
Okay. Thanks, Ed.
All right, let's now turn to our stock of the day. Now, it was IDP Education. It has been in a world of pain. Obviously, in relation to policy changes as far as immigration rates are concerned, not just here but in other markets as well, and also hurt by the rising Aussie dollar. To get across it, our experts, Dean Fergie from Cyan Investment Management and Junbei Liu from TenCap, had a look at it.
The company's pretty well shorted. It does have some net debt, around 200 million, so I think the fear at the moment is a capital raise is potentially coming. Yeah, look, I think momentum's such a strong factor in the market that it's not one you'd probably want to be in at the moment. But you know, look, if they're going to do 130 EBIT on a market cap of 600 million, it looks really, really cheap. But just a lot of government headwinds, both here, UK and Canada.
All right, so potentially a value trap.
Oh, definitely a value trap.
Recently, a lot of visa has been rejected. So I don't know if it's come from the top or maybe just the quality of the student application. So there's high rejection that's coming through at the moment. So that's why Macquarie came through and said, look, it's actually looking very weak. But speaking to the company, it's actually because IDP is high quality operator, so their application is a little bit higher than the rest of the industry. So they have said that there's really not much change from what it was. So things are still tracking as expectations. So potentially there's no downgrade as the market is indicating. I think tactically it's a buy. You know, for it to fall 16% on that downgrade, you know, people are really worried about earnings downgrade, and I think the downgrade is probably not going to eventuate.
10 stocks picked by you, 2 experts, 1 hour.
Let's get to the companies that have been nominated by you.
It's like a witch hunt over there. Everyone hates data centres.
Just remember that most of their earnings are offshore, so there's no franking credits.
The call is brought to you by Centuria, an ASX-listed property fund manager with $21 billion in assets under management. Want to diversify beyond equities? Explore the Centuria Sydney CBD Prime Office Fund at centuria.com.au.
Righto, well let's wrap up this Friday. We'll look at the best and worst in today's trade, beginning with the leaders. 14 Medical off the back of another contract win there stateside. Judo Bank on a recapitalisation. Vulcan Energy to continue to build some refinancing there as its project in Germany. And just in terms of the Middle East trade, you see the gold and the travel stocks moving higher, whereas those that have lost out, we've just heard, stock of the day, IDP Education tumbling 16% today. Champion Iron also coming off. Dexus news in terms of a court outcome there. And some of those energy stocks also falling as a result of the news out of the Middle East. Just turning to the small caps, Tourism Holdings. Some news in terms of a acquisition there. Amero, Challenger Gold, as I mentioned there, Gold Brand's doing well. KMD Brands back on that list, up more than 13%. And those two have fallen, led by Anteo Tech, Energy Transition and Advanced Energy Minerals. So tonight, getting across what we can expect, the Bank of England Governor Andrew Bailey will be speaking, and also the goods trades balance out of the US. Looking ahead to next week, the highlights being the ISM manufacturing PMI out of the States, and Wednesday, midweek, we get a read on first quarter GDP, the March quarter here in Australia, plus that key non-farm payrolls report out of the US, and also we get some commentary from the Reserve Bank Governor Michelle Bullock. Obviously a lot of speculation about what the RBA is going to do next, with well, more and more economists expecting they will hold at next month's meeting. Okay, so let's take a look at where we're likely to finish. 1.3% higher on the SIBO 200. Similar moves there we've seen on the S&P ASX 200, which is looking like it's going to end up around 0.6% higher for the week, almost recapturing those losses we saw yesterday. So that's where we landed at the end of the week, and join us again next week on Monday. Thanks for watching and listening.